Well, good morning and good afternoon, everyone. I'm Elliot Kallen, CEO of Prosperity Financial Group, and I'd like to welcome you to another episode of Meet the Expert. Well, this is a really interesting program today. We're with Simeon Hyman. Very, very exciting what we're doing. He is the CIO for ProShares. ProShares is a specialty company on the East Coast that works with ETF, exchange traded or electronically traded funds. I don't want to get too much into the weeds of this. We'll talk more about this. But it's a specialty house with a lot of sharp focuses on what they do. And right now, our world is kind of upside down. We've got Russia with Ukraine going on right now. We've got inflation. We've got interest rates. We've got shipping that seems to be messed up. We've got China stress going on there with Taiwan. We've got containers lined up off of Long Beach, California, 2 miles long, trying to get in here. So we've got a shortage there. We've got problems with finding enough employees. We're coming out of COVID. Oh, my goodness. I could come up with a whole long list of things that are disruptors to the normal economy. And that's after 2 years of lockdowns and masks. So we've got a lot to talk about today because we're going to talk about the economy and the markets. What everybody wants to know is, am I going to be able to make money? Because at the end of the day, our slogan is, if it's money, it's personal. And boy, it's personal. I want to make some money. And so that's how people think about their money. So Simeon, I'd like to welcome you to our show.
Thanks so much for having me.
Absolutely here. So let's talk a little bit about what's going on, how we feel about this. And I know you deal in a world of money literally every day from the 40,000 foot level. And so you're really speaking to clients and prospects here about their money and ideas and how to protect themselves and opportunities. And I'm a big believer that out of every crisis comes opportunity. And you know, from going back to the Rothschild family 500 years ago, when they believed in a French Revolution, and they were buyers when the French were revolting. And that's where the phrase, always buy when the streets are turning red, came from. So be a contrarian. So there's a lot in the world going on to be a contrarian about right now. So let's talk a little bit about that. Can we do that?
Absolutely.
Let's start with that. We're in a very nervous time for our clients. I've been watching the markets today. There've been massive swings on what's going on with politics, with war, the drumbeat of war. 2 weeks ago, no one in the United States even could spell Belarus, much less knew if it was in Europe or on the Straits of Taiwan. Nobody knew where that was. Now suddenly it's the border of Ukraine. Probably half the people in the country didn't know if Ukraine was in Europe or Russia, or Europe or Asia. The confusion on that, and what's the difference between Ukraine and Turkey? Suddenly everybody seems to know what's going on over there with our 24-hour news in a way that's never been seen before. So what kind of impact is this having on volatility and behavioral finance, which means fear and scarcity, that we should be aware of?
Well, first, just I would be remiss to not start with the notion that clearly our thoughts and prayers are with the people of Ukraine, and in moments like these, the health and safety of human life out there in the field is of paramount importance. But we do have a job to do, and I'll certainly do my best to share some thoughts with regards to what we've seen historically in times of geopolitical unrest, how that's tying into things that were happening in the markets prior to and will likely happen subsequent to the Russia-Ukraine crisis, and maybe some thoughts on how to position portfolios. I think that one of the key takeaways, as you said, there are opportunities when situations like this unfortunately surface. And when you look historically, geopolitical risk, crises like this are more often than not shorter in duration than ones that come from economic cycles. So as an example, the financial crisis, the great financial crisis, the Great Recession, took months and months and months and months before the bottom was found, and a couple of years before you recovered those losses. But if you look at more acute periods of geopolitical unrest like 9/11, you're talking a drawdown measured in days and weeks and a recovery measured in a few months. So most typically geopolitical challenges don't last that too long and don't have a real long-lasting implication for portfolio performance.
Okay, so that's good news for investors who are a little bit scared. And I had one investor that said, make sure we convert everything to gold before the day is up. And I just sat here and I said, so what are we going to do with the gold? Where does that go? If Safeway cash registers are shut down because of a cyber attack, what do they do with the gold? Can't buy anything anyway. So we're talking with Simeon Hyman, who's the CIO of ProShares on the East Coast. I'm Elliot Kallen. If you need to reach me, I'm at Elliot, ELLIOT, at prosperityfinancialgroup.com. The website is prosperityfinancialgroup.com. We'd love to hear your input. We'd love to hear your questions. Reach out to us because we're going to talk about markets and politics, and that's what we do on these episodes of Meet the Expert. So come join us anyway. So let me talk about something that was happening. Maybe it's kind of irrelevant now, or less relevant is maybe a better way of saying that. And that was interest rates, inflation, the fear, the Federal Reserve. There was a lot happening right before the invasion of the Ukraine. And there was fear that we have runaway inflation of 10%, which means I have less buying power as a consumer. We have fear that the Federal Reserve is going to raise interest rates so we don't have what happened in the 1970s. And if that does, that clamps down on the world of bonds, makes them less attractive in that world of fixed income, which means that for clients that are looking for safety, security, conservativeness in their investing are almost guaranteed to go down. And we don't want that to happen. So what's going on with inflation now? What is going to happen with the impact of that on portfolios for our most conservative clients? And at the same time, how do our clients and how can we as portfolio managers hedge this so the client, based on this negative event of inflation, can be the winner because they hedged it properly and we did it for them?
Great questions. And the core of the answer here is that most of those things that we were worried about, namely a little bit of inflation and rising interest rates, those concerns are not really dissipated or dismissed because of the Russia-Ukraine conflict. If anything, the inflationary pressures are probably a little bit of enhanced for a little while because of the pressure on oil prices and commodities. Some of these pressures, by the way, we're mitigating. You mentioned, Elliot, at the top of our discussion, all the ships that were lined outside of Long Beach, and I'm an East Coaster. There were some outside of Newark too. Some of that pressure started to mitigate at least prior to the conflict. So the Baltic Dry Index is the measure of the cost of those dry bulk containers in those ships. It actually fell about 75% from its peak last October. So there was some promising signs that 7-8% inflation was probably going to come down to maybe not the Fed, which targets 2, but something like 3 or 4. And that still seems more or less in the cards. It also seems in the cards that the Fed will hike interest rates even in the face of the geopolitical concerns. Now, maybe if you thought there were going to be 8 rate hikes, maybe there'll only be 4 or 5, but they're likely to be some. And very importantly, we're also likely to see, and we've already seen this, the end of what was called quantitative easing, the end of the Fed buying bonds to artificially suppress interest rates. So what do you do with your bond portfolio in the face of rising rates? Now, by the way, the only real reason you would want rate exposure is if rates are going to fall, because when interest rates come down, bond prices go up. And I've always said, hey, the only time that might really work in an environment like today is if there's some big geopolitical conflict. Okay, we just had it. But interest rate, to think about how much pressure there must be on interest rates to rise, they've only come down a smidge since the Russian invasion. So it's very likely that as this dissipates, rates are going to go up. What does that mean? Bond prices go down. It means your safe fixed income investments are not so safe. What's an answer? You hinted at it. Excuse me. We think one of the best approaches is to actually formally hedge the interest rate risk in your bond portfolio. Now, you only do this with corporate bonds. If you did it with treasury bonds, you would just be recreating cash, because the only risk in a treasury bond is interest rate risk. But a corporate bond has this spread. You have to earn more interest on a corporate bond because it has a risk of default. And if you buy those corporate bonds and you hedge the interest rate risk, you got a great opportunity to make some money even as interest rates rise. And by the way, because to your point of opportunity in times of stress, that spread on those corporate bonds has actually widened, much like equities have lost a little money during this geopolitical crisis, which means you have an entry point that has even a little bit more upside to this strategy. So that's certainly one possibly important element of a fixed income portfolio in a rising rate environment, is to actually hedge the interest rate risk in a corporate bond portfolio. We do that in our ETF ticker IGHG.
What does the word hedge mean to an investor, to our clients? What does that mean?
It means that you're actually protecting your investment from the impact of those rising rates. So think about owning a corporate bond. If you own that corporate bond, there are two risks. One is the underlying treasury rate risk, and the other is the spread on top of it. So imagine today the 10-year bond is at 2% and a corporate bond is at 3%. There's pretty high odds that that 10-year interest rate is going to go maybe to 2.5%. The corporate bond might only go up to 3.25 because those spreads are compressing. We want to protect that portfolio from just the increase in the treasury rate. So in effect, what we're going to do is staple a short position in treasuries to that corporate bond portfolio, isolating the good credit part, particularly attractive after the Russian invasion of Ukraine, and isolating that in the portfolio. So the hedge takes a specific position contrary to the impact of those rising rates on the treasuries, stapled to the corporate bond portfolio.
Okay, confusing for clients, and that's why we build portfolios and have conversations here. Simeon, when we're talking about inflation, let me just stay with inflation for just a moment. My concern is that we're dancing with China. And we're dancing with China where their goal is perhaps some type of world domination. I don't know if they're going to go into Taiwan or not, but it's to control really purchases throughout the world. They want to dominate the economic world. They're already dominating a big part of it, which means prices are going up there as well. And that's where inflation is coming from as well. So when you're talking about hedging interest rates, I know that's just the beginning of the word hedging. What does the consumer need to be aware of to say, hey, I want to take more risk or less risk as an investor with you, Elliot? What should we be looking at and having a conversation about?
The good news is that inflation is usually driven by an improving economy. Now, there's only one state of the world where that doesn't happen, and it's when there's some sort of external shock. And that happened in the 1970s with the oil crisis. I think if you talk to most observers of the current geopolitical setup, that's not the expectation. In other words, we are likely to resume, whether it's in a couple of weeks or a couple of months, a path of economic expansion that's driving that inflation. And when that's the scenario, it's actually okay to take some risk. In fact, historically, equities have done just fine in that scenario. Bonds are defenseless. A bond pays a fixed coupon. So when those interest rates rise, bonds have to lose money unless you hedge and protect yourself. But equities grow. That's why equities are so important. Their cash flows, their earnings, and really importantly, for a select number of stocks, dividends grow. And there's no better bulwark against inflation than the growth of those dividends in your portfolio, adding to cash flow over time. So you really can't do the turtle thing in the face of some of this inflation. You have to take a little bit of risk, but we certainly think one prudent path for that is companies that consistently grow their dividends, because you can't fake them. You can't manufacture dividends unless you're really generating those earnings and cash flows and managing your balance sheet very effectively.
So that puts us into the where are we investing? And So I'm a big fan. I mean, I know there's a global world out there. There's places to invest outside the US, and we take advantage of them, but we invest nothing in China. We haven't been investing in China for 4+ years now. We do have some in Europe. Obviously, it's getting pounded right now, but we feel that'll come back. But for the most part, I've been a big fan of what's called King Dollar, the old Larry Kudlow King Dollar concept. America's got good companies. We manufacture in smart situations. We know what we're doing. And I know that growth right now has been pounded. The technology sector has been pounded, but it's not going to be there pounded forever. It'll swing back because America has good companies. But we also know America has great companies that have great cash flow and world leaders. So I know you're a big fan of investing in these companies. Tell me how this works and how clients can benefit by companies, American companies primarily, that have great cash flow, and how are they the beneficiary here?
When you look at companies that have been able to consistently grow their dividends year after year after year, as you mentioned, this is the clearest evidence that they are growing their cash flow over time, because you can't fake it. But there is also another important benefit of companies that consistently grow their dividends, and that is what they're telling you. If a company buy back some stock, that means the good times were yesterday. So they have some extra cash around, they'll buy back some stock. But when a company increases its dividend, nobody ever wants to cut a dividend. So that is a really powerful forward-looking signal of the ability to grow those cash flows and those dividends over time. That's a really powerful combination. It's an evergreen powerful combination. It's particularly effective in the US and is particularly important in an inflationary environment. To give you an example, the S&P 500 dividend aristocrats, these are companies that grow their dividends for 25 straight years. Our ETF follows the index, its ticker NOBL. Those companies last year grew their dividends double digits, and even in 2020 at the depth of the pandemic, grew their dividends double digits. And that's in a period of time where the S&P 500 barely squeaked out any growth of dividends. So yes, you're US centric in this environment, not a bad idea, but focusing on those dividend growers can really be belt and suspenders in this kind of environment.
Okay, so you mentioned COVID and what's going on with that. Obviously, we're coming out of COVID, unless by the time we speak and this airs, we have another odd breakthrough of COVID. But we're coming out. The world basically shut down. We shut down. You shut down. You're working still out of your house, I'll assume.
I thought it wasn't so obvious I was in my house. I have this clever background behind me.
It does. I can't tell if that's a curtain, a shower curtain, or a banner. It's all good. But it's changed the way people are shopping. It's changed the way people are looking at this. And I have to say, I've been a big fan of supporting local stores and local restaurants through this whole thing. But I'm now having things delivered to me much more than I ever thought I would. I'm buying more on Amazon. I'm buying on Costco.com. I went to a vitamin store the other day, my favorite vitamin store, where I get a nice discount that they extend to their steady members. And the shelves were 20% bare. I thought, I just got to buy more stuff online. And I did, because they just don't have it anymore. So the world is changing on retail. You know, 2 generations ago, we would be talking about Sears and Roebuck and how they're doing so well, and JCPenney and how they're doing so well, and some of these brick and mortar stores, and and Macy's. You got to go to the mall to go to Macy's, and who's bookending and who's anchoring the mall. We're not having that conversation right now. We're having a conversation of malls might be closing and becoming, townhouses. So retail shopping is changing. How do clients, rather than be scared of Macy's and be scared of where they invest, how do they take advantage of this besides just buying Amazon stock at $2,000? What do they do? How do they take advantage of this?
From our perspective, there really is an opportunity to invest in online retail. And at ProShares, the way we did this is we realized a number of years ago that the retail investable opportunities were kind of muddled. In other words, you had to invest in the sector, which was a mix of online and old brick and mortar stores. And we simply split them up. And we have an ETF ticker ONLN that invests in the online retailers. Now, there's an evergreen part of this story, and then there's a particularly interesting current entry point, as I'll describe. First, many people would be surprised to hear that despite all the packages piling up in front of your front door, today, just under 13% of US retail is actually conducted online. I think if we took a poll of people, they would say 40, 50, 60, 70, 80%. So we're much earlier in this transition than I think people anticipate. The trajectory has been growth of maybe about 1.5% a year. So that would mean just 4 or 5 years from now that the online retail opportunity would be 50% bigger. So that's a big growth opportunity. But there's also an entry point that's interesting. Now, why is that? Number one, there has been what I would suggest is a excessive rebound of the brick and mortar stores. Elliot, to your point, as we begun to emerge from the pandemic and stores reopened, there's been a rally in brick and mortar stocks, which probably has gone a little too far. In fact, the valuation of brick and mortar retailers compared to online retailers is now double what it was before the pandemic. Doesn't seem to make any sense, especially when the margins of the online retailers continue to grow at the expense of the brick and mortar folks. The other item is China. You mentioned there's a big regulatory overhang in China. ONLN's portfolio was global. About 20% of it was China, and it got decimated. Where are we at today? This attractive long-term secular growth opportunity, online retailers, they're trading at half the valuation of the consumer discretionary sector, and the Chinese piece is trading at 25 cents on the dollar. So an opportunity to engage in the long-term trend, but at a particularly opportune moment.
Well, that's a good point, Simeon, when we talk about risk. And we're talking with Simeon Hyman, who is the CIO of ProShares, a boutique ETF, exchange-traded fund company on the East Coast, $75 billion large. I'm Elliot Kallen, and so if you need to reach me, I'm Elliot, E-L-L-I-O-T, at prosperityfinancialgroup.com or Prosperity Financial Group, www.prosperityfinancialgroup.com. And my direct line is 925-314-8503. Drop us a note. Tell us what you think of these. We'd love to hear that. Let me talk about risk for a second, Simeon, because you talked about, something is cut in half or down by 25% and so forth. And I know that you've been heavily investing in online pet stores. And COVID, boy, we love our pets in COVID, but we proved that. But and financial, everybody that buys something online is using credit cards or Venmo or PayPal and or MasterCard. And these are companies that have just been beaten on in 2021. Some of these down 40, 50%, some of these companies, which would make no sense because we're not buying less online, we're buying more. So how do financial technology firms like PayPal and Venmo and MasterCard, they go down so much? And then, or pet stores like PetSmart go down so much when profits are just going up on all of them so much? How do you have such division, dichotomy, lack of understanding? And then how do you explain that to clients? How can they comprehend saying, I want to be in front of the trend and the trend is going down, but the real dollars are going up? There's a real division in logic and investing here.
Look, you do get disconnects from time to time. Was it the old Buffett wisdom that said that the market is a popularity machine in the short run and a weighing machine in the long run. So sometimes you do have to look through. And indeed, I think a lot of this was over the past 6 to 12 months, simply a rebound in some of the traditional brick and mortar players that just went too far. And really, if you think about these were companies that were trading at 40% of the price to book of online retailers in 2018, and now they're up to 80%. And that's exactly in a period when the margins of those online retailers increased dramatically, but went nowhere for brick and mortar folks. Sometimes disruptive technologies, sometimes the incumbents win, but usually they don't. And there's still so much pain, so much store closing that has to be done. We are years and years away from the footprint of a Walmart turning into half a robot-driven drone thing for last mile delivery. When we get there, this won't matter anymore, but it matters for a long, long time from here.
So we've been talking with Simeon Hyman, and let me wrap this up if I could, because you've been great about your answers, and that is contrarian. Think like a contrarian. because I know you're trying to do the same thing there. The big investment houses do the same thing, but most investors run with the flock. They don't think contrarian. They think, okay, if somebody's selling, I must be selling too. If somebody's buying, I need to be buying. So they're buying too high and they're selling on the downside. They're doing the opposite. What you want, what advice do you have for our clients to be a long ball player, to think out of the box, to when the market goes down, to think it's everything's on sale. I need to be a buyer. Everything's being going up. I need to take some profits. And it runs so counter in the investment world, but it runs if I was a retail buyer at a mall and I found out they were having a 40% sale and I needed those scarves or suits or cosmetics, whatever, I'd be running over there right now. But in our world, they're selling instead of buying. What advice can you give us?
Well, look, the first thing you might want to do is sit on your hands to make sure you don't do anything stupid. And that's first principle. The second thing is to pick up the phone and call you guys and discuss, because it is hard. It is behavioral finance is so much. The recency effect is big and risk aversion is big. These are real things that cause momentum in the short term. So folks are not alone. That's why momentum can drive markets for weeks and even months. But if you have a reasonably long time horizon, and I'll remind people what a long time horizon is. It's not just retirement, because I'm hoping not to die at 66. My mother's 98. So when I hit retirement, I think I'm hoping for another 30 plus years to go. So most of us have pretty long time horizons. A good thing to do is nothing. An even better thing is to take advantage of some of these opportunities.
Well, great. Simeon, you've been great on that. Really appreciate your help here and for our clients. So Simeon is the CIO of ProShares. If you want to know about some of the symbols that he talked about, and we talked a little bit about risk and understanding the risk associated with investing, give us a call, 925-314-8503. We'll show you how we use the ProShares products as part of our portfolios. So you can understand what we're doing, the logic behind it between our many portfolios. So Simeon, thanks so much for being part of today.
Thanks for having me.
And we look forward to seeing everybody on the next episode of Meet the Expert. Have a great day, everyone.